Our story begins with an IRS investigative analyst with the Boston field office. Around May 2019, the IRS analyst began reviewing information relating to taxpayers with large Schedule C losses over a number of consecutive tax years that may have exceeded a certain threshold. A quick tax lesson before we continue. A Schedule C is used to report income or loss from a business that someone operated or a profession that the person practiced as a sole proprietor or as a contractor. This person has to engage in the activity for income or profit, and he or she has to be involved in the activity with continuity and regularity. For example, a hobby does not qualify as a business. Now, there is a presumption that an activity is engaged in for profit if the activity is profitable for 3 years of a consecutive 5-year period. Because of this presumption, the IRS investigative analyst was looking for tax returns, reporting large, prolonged business losses, maybe for 5 or more consecutive years. For these returns, the IRS suspected that the claims were not truly business-related losses, but may instead have been attempts to evade federal income tax liabilities and/or receive tax credits. During this review, the IRS analyst noticed one taxpayer in particular, a lady that reported huge losses on her personal tax returns for 10 years straight. Every year she would claim a business loss between $20,000 and $60,500, for a total of $413,116 in business losses claimed over the period between 2010 and 2019. One other important thing that the IRS analysts noticed is that this person had a W-2 form reporting wage income, with the employer listed as the United States Department of the Treasury, which of course raised the suspicion that this person was a government employee. After further investigation, the IRS analyst discovered that she was an IRS revenue agent that had been working for the IRS since 2006, having been assigned to the Large Business and International Division. This was not just a regular IRS agent. She was highly educated with a master's degree and a certified public accountant certification, and she was highly trained, with a lot of experience in auditing complex income tax returns filed by large businesses, corporations and organizations. She was also a university teacher, teaching accounting and auditing. This was mind-boggling. You wouldn't expect tax fraud from a professional like this. Of course, the IRS analyst referred her for investigation and audit. Now they were only able to audit her 2017, 2018 and 2019 tax returns because the tax returns for tax years 2010 through 2016 were filed more than 6 years ago, and were therefore beyond the statute of limitations applicable to Title 26 tax offences. But these 3 years were enough to expose her to a lot of years in prison and hundreds of thousands of dollars in fines. For example, the charge of filing a false tax return provides for a sentence of up to 3 years in prison, followed by 1 year of supervised release and a $100,000 fine. The charge of filing a false tax return by an employee of the United States provides for discharge from employment and a sentence of up to 5 years in prison, followed by 1 year of supervised release and a $10,000 fine. Add she was indicted on 3 counts of filing false tax returns and 3 counts of filing false tax returns as an employee of the United States. If convicted, her life will be ruined. And for what? Over the 3 years audited, she cheated the IRS by about $20,500. Is $20,000 worth your life? But let's see what she did. She created a fake import and export business and claimed false business expenses more than the fake business income, generating a loss that reduced her other income, the wage income from the IRS and her teacher's salary. The investigators looked at all her bank accounts for the period audited, email accounts, talked to her neighbors, but they couldn't find supporting evidence for business sales or business expenses, or even any contacts that appeared related to a business. Although they found a very small amount of some expenses that could have been considered cost of goods sold from Costco and some thrift stores, these were insignificant compared with the amounts she claimed on her Schedule C forms. In addition, they did not find evidence that she operated a for-profit business, and because of that, she was not entitled to claim these expenses anyway. Now keep in mind that all these are allegations. As a defendant, she is presumed innocent unless and until proven guilty beyond a reasonable doubt in a court of law. But let's see what are the takeaways of this story. Make sure to keep receipts, because credit card statements and bank statements are not enough. Keep emails, contracts, and any documents that support your tax deductions and credits. And if you have a business showing prolonged losses, be aware of the risk of being flagged as having a hobby instead of a for-profit business. Document as much as possible your efforts in making your business profitable. This concludes our story for today. Subscribe to our channel and give a like to this video if you found it helpful.